Hello and welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of Abbvie Inc., ticker symbol ABBV. So yesterday we took a look at Abbott, which about 10 years ago spun out Abbvie. So today we're looking at Abbvie to look at the other side of that spin out. Since they were spun out about 10 years ago, Abbvie has steadily increased their dividend payouts each year. And when we combine their 10 years of market history as a standalone company with all of the years that they were included as part of Abbott, Abbvie also qualifies as a dividend king, meaning that they have consistently raised their dividends for each of the past 50 years. So at the time of recording this video, Abbvie is trading for just over $140 per share. Year to date, their stock price is up 6%. Going back over the past year, they're up 21%. Over 3 years, they're up 30% compounded annually. And going back close to 10 years, they're up about 16.5% compounded annually. Keep in mind that these returns are not including dividends, and currently Abbvie nearly has a 4% dividend payout yield, so significantly above the overall market. Abbvie is trading squarely between its 52-week high and low. Abbvie is a very large business. Even though they were spun off from Abbott, they are now larger than Abbott is. They have nearly a $253.5 billion market cap, so quite large. For some background about the business, Abbvie is a pharmaceutical company with a strong exposure to immunology and oncology. The firm's top drug, Humira, represents close to half of the company's current profits. The company was spun off from Abbott in early 2013, and the recent acquisition of Allergan adds several new drugs in aesthetics and women's health, including Botox therapies. Abbvie was incorporated in 2012 and, just like Abbott, is based in North Chicago, Illinois. So for today's fundamental stock analysis, we're going to be performing a modified version of the 8-pillar analysis popularized by Everything Money, taking a look at 8 key financial metrics of Abbvie to come to an overall holistic and beginning understanding of their business based on those fundamentals. So let's get right into it. Starting off here with pillar number 1, we want their average PE over the last 5 years to be below 22.5. Currently, Abbvie is trading for about 20 times earnings. Over this time frame, they've gone down to a low of 12 times earnings and a high of about 45 times earnings, but averaged out, they're trading at a 26 times earnings multiple. So slightly off here, but this is going to be an X to start off on pillar number 1. Pillar number 2, we're looking for an average 5-year return on capital that's above 9%. Over the course of decades, over the long run, a stock is going to return approximately what its underlying business returns, and those underlying business returns are going to be captured here by return on capital. So Abbvie consistently earns above average returns on capital, although it has fluctuated somewhat over this time frame, with a high of 36% return on capital in 2018 and a low of about 15% return on capital in 2020, they are solidly earning about 23.5% returns on capital in an average year. So this is going to be our first check here on pillar number 2. Pillar number 3, we're looking for 5-year revenue growth. Abbvie has nearly doubled revenues here from $28 billion in 2017 up to about $56.2 billion in 2021. That's another check here on pillar number 3. Pillar number 4, we're looking for 5-year net income growth. Similar to revenues, Abbvie has doubled their net income over this time frame from $5.3 billion in 2017 up to $11.5 billion in 2021. This is a check here, and so far through 4 pillars, we've got 3 checks on Abbvie. Pillar number 5, we're looking for decreasing shares outstanding. When you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. When a business buys back stock and decreases their number of shares outstanding, they're increasing your ownership percentage in the business, ultimately increasing the percentage of the business's profits that you're going to be entitled to without you having to spend a dime. Here, unfortunately, we're seeing the opposite. Abbvie has diluted shareholders over this time frame. They had about 1.6 billion shares outstanding in 2017, and that has increased to nearly 1.8 billion shares outstanding as of the end of 2021. So over this time frame, Abbvie has diluted existing investors by about 11%. So this is going to be an X here on pillar number 5. When considering any investment, we want to be especially careful with shareholder dilution because this is something that can go under the radar, but being excessively diluted, especially as a long-term shareholder, ultimately is going to rob you of the business's profits that you thought you were entitled to when you were buying into the business to begin with. While this isn't terrible dilution, this is something to keep an eye on. Again, this is an X on pillar number 5. Pillar number 6, we're looking for 5-year free cash flow growth. Free cash flow is cash from operations minus capital expenditures. It's the lifeblood of any business, and a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is ultimately what that business is going to be valued at. Free cash flow can be used to reinvest back into the business, make acquisitions, buy back stock, pay dividends, or pay down debt. In 2017, AbbVie produced $9.4 billion of free cash flow, and that grew all the way to about $22 billion in 2021. So this is a massive check here. They've more than doubled free cash flows over this time. A big portion of this increase came on the back of their Allergen acquisition in 2020. Looking here at their cash acquisitions, they spent nearly $40 billion to make that acquisition, in addition to issuing those shares. So they paid a lot of money for that business. Yet at the same time, they increased their free cash flows by nearly $5 billion year over year between 2020 and 2021. So it looks like they're getting strong cash flow returns on that acquisition so far. So in an average year over this time frame, AbbVie is producing just about $14.75 billion of free cash flow. So we'll be using that number when we're evaluating how the business utilizes leverage, and then how the business's abilities to produce free cash flows compare to its overall market cap. So pillar number 7, we want their net debt, which is long and short-term liabilities minus cash and short-term cash equivalents, to be below their average 5-year free cash flow multiplied by 5. This will help us evaluate how the business utilizes leverage. We don't want to invest in businesses that are overly levered. Highly levered businesses are more likely to incur significant risk, especially during hard economic times. While all businesses have the potential of failing and potentially going bankrupt, highly levered businesses are more likely to do so. And highly levered businesses are typically going to be the businesses raising capital. And when times get rough, they're usually getting the short end of the stick on those capital raises. So as of the end of last year, AbbVie had nearly $68 billion in net debt. So while this is a lot in absolute terms, but when we multiply their average 5-year free cash flow of $14.75 billion times 5, that comes out to just under $74 billion. So this is a check here on pillar number 7. Although they've got a lot of debt in absolute terms, they're producing a ton of free cash flow, and they actually are able to support this debt load. So if AbbVie keeps having average years over the next 5 years, they'll have plenty of cash left over to be able to pay off all of this debt. So that's a good sign to see as the business is utilizing reasonable leverage here. Finally, the big pillar of them all, pillar number 8, we want their market cap to be below their average 5-year free cash flow multiplied by 20 to give us a reasonable starting point for evaluation of the business. So currently, AbbVie has a market cap of about $253.5 billion. When we multiply their average 5-year free cash flow of $14.75 billion times 20, that brings us to $295 billion. So there's nearly $41.5 billion margin of safety here based on their market cap. This is a big check on pillar number 8. However, just because this is a check doesn't mean that you run out and buy the business. This type of analysis is best used holistically, and it ultimately serves as a beginning fundamental understanding of the business, really to determine whether it's worth your while to go out and do further due diligence and learn more about AbbVie as a company. So again, this analysis is not financial advice, it's just a starting point. Finally, as mentioned, AbbVie is a dividend king right alongside its sister company Abbott. So even with this historical pedigree of consistently paying out an increasing dividend, we still want to make sure that we're not making mistakes as investors by blindly chasing dividend yield. So we want to determine if a company's dividends are sustainable and healthy now and into the future. And the way to do that is to make sure that they're supported by the business's free cash flows. So no surprise, in each of the past 5 years, AbbVie has increased their dividends per share. And over that time frame, they've also steadily increased their free cash flows per share. During this time, they haven't had to pay out more than a 50% dividend payout ratio, which means that they're conservatively paying out these dividends and they have a good margin of safety between their cash flows per share and their dividends per share to continue growing this dividend, likely now and into the future, with potentially a nice runway ahead of them. While past performance is no guarantee of future performance, this historical snapshot looks pretty good. So in summary, AbbVie checks the box on 6 out of 8 pillars. They're a little off on historical PE metrics, but they average significantly above average returns on capital. Over the last 5 years, they doubled revenues, net incomes, and free cash flows. And although they have diluted shareholders by about 11% on the back of some of these acquisitions, especially their big Allergan acquisition in 2020, the business is still utilizing reasonable amounts of leverage. It looks like there's a margin of safety based on the business's abilities to produce free cash flows compared to its overall market cap right now. If you're interested in learning more about AbbVie, I highly recommend checking out the business's filings. Being a pharmaceutical company, they're heavily dependent on both their pharmaceutical distribution and their pharmaceutical drug patents overall. Reading through the business's 10-Ks will help you learn more about the potential opportunities and the potential risks associated with those. So if you're interested in AbbVie, I would highly recommend checking those out. So with that said, that's it for today's fundamental stock analysis of AbbVie Inc., ticker symbol ABBV. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about AbbVie with me, and have a great day.